Listen, if you think private equity values your business off some random 6 to 8 times EBITDA multiplier you saw in a Facebook group, you are already lost. That is rookie talk. Today, I am going to break down every single way that private equity actually values a business. Over 15 lenses, 5 different models, and the truth that nobody ever tells founders. So get ready, because after this video, you will never look at your business the same way again. Let's go. Everybody thinks that PE walks in the door with one question: what's your EBITDA? Wrong. That is the last question they ask. Private equity runs layered valuation, and I'm going to show you every single layer, because your value isn't just one number. It is a stack of numbers, and the buyer chooses the one that helps them the most. So here is how they play the game. Step 1. PE doesn't ask, what do you think you are worth? They ask, what are similar companies actually selling for? This is the comparables analysis, and it has 2 separate versions. The first is public trading comps. PE looks at public companies and calculates EV/EBITDA, the king, EV/revenue, fast growth, PE, public market lens, and EV/EBIT, CapEx heavy sectors. Next, sector multiples, EV per subscriber, bed, patient, store, user, B/E, whatever drives your industry. They take the median. Then they discount you because you are smaller, you're private, you're riskier. Welcome to the game. The second is Precedent Transactions. Then they ask, what did similar companies actually sell for? This is where real valuation lives. Deals, M&A comps, control premiums, what strategist pays. They pull data and build a range. Deals in this sector close at 7 to 10 times EBITDA. That's not your number, it's theirs. Now, the second lens, the income approach. This is where they say, forget comps. What is the stream of cash flows worth? 2 models matter. First, discounted cash flow, or DCF. They predict your future cash flows, discount them back using WACC, risk, size, capital structure. This is the math nerd model. Most founders never even see it, but it is there, running in the background, pricing you quietly. Second is economic value add, or EVA. They ask, does this business generate returns above the cost of capital? If yes, it's a premium. If no, it's a discount. 99% of founders don't even know what their EVA is. Private equity loves that. This is the break glass in case of an emergency model. Private equity asks, what are the assets worth if we sold them tomorrow? Why? Because it's used for distressed businesses, asset-heavy firms, early-stage companies with no cash flow. If this number is low, they use it as your floor to negotiate down. Welcome to Valuation Jiu-Jitsu. Now, let's talk multiples. Everybody online throws around random numbers, but here is the truth. PE doesn't use one multiple, they use a stack. Let's break them all down. First, EV/EBITDA. This is the king. This is 80% of private equity deals. Why? Because it removes interest, taxes, depreciation, amortization. It shows pure operating performance. It ignores your capital structure. That is why PE loves it. They're about to change your capital structure anyway. The second is EV/EBIT. This is CapEx heavy situations. We're talking about manufacturing, industrial, any business that burns cash maintaining assets. This one exposes the truth EBITDA hides. The third is EV/revenue. This is high growth companies. No profit, it doesn't matter. SaaS, DTC brands, marketplaces, tech. Revenue multiplies rule until EBITDA shows up. The fourth is P/E, public market exit tool. It's used when PE models a future IPO. It's not used for day-to-day valuation. And the fifth, free cash flow multiples. PE loves cash. Cash pays debt. Debt drives IRR. It's a simple equation. More cash equals more value. Number 6, industry-specific multiples. These matter more than anything else. EV/ARR for SaaS, EV/clinic for healthcare, EV/bed for senior care, EV/user for consumer applications, EV/customer for subscription-driven businesses, EV/BOE for oil and gas, EV/store for retail, EV/car for auto service. If you don't know your multiple, you're negotiating blind. This is the most combative part of valuation. Private equity will tear your P&L apart and rebuild it from scratch. They will remove one-time events, founder lifestyle expenses, personal spending, amortized owner benefits, over-under market salaries. They will add professionalized management, pro forma hires, tech upgrades, future improvements they claim should be normal. Founders hate this part because, pay attention, every dollar of EBITDA you lose in adjustments can cost you $6 to $12 in valuation. And yes, PE knows that too. Now, here's a mind trick that no one ever talks about. After running all those valuations, PE adds or subtracts invisible adjustments. First is a size discount. Small equals risky. Risky equals lower multiple. Second, liquidity discount. Private shares can't be sold. It's a 20 to 30% haircut. That's standard. The third is a control premium. If PE buys control, they pay a little bit more. The fourth, minority discount. If PE takes a minority stake, they pay less because they don't control decisions. This is valuation psychology, not math, and it affects every single deal. This is where the game gets real. PE asks, what's the max price we can pay and still hit our return target? This is the LBO model, the most important calculation in private equity. You can sell for whatever you want, but they can only buy it at a price where leverage works. Cash flow covers all debt. They hit 20% plus IRR. Exit multiple doesn't collapse. This model is their ceiling. Even if you're worth more on paper, if the LBO doesn't hit the target IRR, PE won't buy. PE never buys off of one model. They run base case, downside, recession, no multiple expansion, margin compression, customer churn hit, interest rate shock, zero bolt-on scenario. If the deal breaks in downside, you are done. Here's the most underrated piece of valuation. You're not valued in isolation. You are valued in the context of their fund. They will ask, do we already have too much inside this sector? Do we need more recurring revenue? Do we need a platform or a bolt-on? Does this round out our thesis? Your valuation may drop or rise based simply on whether you feel a strategic gap for them. That is the difference between founder math and fund math. Now, let's talk about the next wave hitting valuation. First, higher for longer rates. Debt is still expensive. This caps valuations. No more multiple expansion era. You must grow earnings. Second, AI valuation engines. Tools like 73 Strains, Hamilton Lane, and AI-powered valuation stacks are normalizing data, scrubbing comps, running real-time scenario models, auditing assumptions, flagging optimistic projections, doing quarterly valuations automatically. Valuation is becoming algorithmic. Third, regulatory pressure from the SEC, the EUAI Act, etc. Regulators are now requiring AI governance, no AI washing, clear documentation, bias testing, transparent assumptions. Your valuation model itself may need compliance. The future of valuation is faster, more regulated, more AI driven, less negotiable. If you're a founder watching this, here is the truth. Your valuation isn't determined at the negotiating table. It is determined years before you ever talk to the buyer. Private equity rewards clean financials, predictable cash flow, documented processes, customer stickiness, recurring revenue, strong margins, leadership teams not dependent upon the founder, scalable operations, tech-enabled efficiency, a believable growth story. PE isn't buying your past. They are buying your future. And the business with the clearest future gets the highest valuation. If this video woke you up, good, because this is the exact playbook private equity uses to write multi-million-dollar checks. And now you know it, all of it. If you want the next video where I break down the entire LBO model line by line and show you exactly how PE calculates IRR and deal price, comment LBO below. I'll see you in the next one. Let's build something legendary.